I'm Ruth Hackney. I'm the CEO here at the Realtors Association of South Central Wisconsin. I'm so excited to welcome Dr. Lawrence Yoon today to speak to our membership. The format of this call, of course, is a webinar, so the participants are off camera and muted. You can ask questions, though, using the chat function, and our wonderful Nicole is going to be tracking those questions and then moderating the conversation after Dr. Yoon is completed. Nicole Bunbury-Showall is our longtime member and our 2021 president. So huge thank you to you, Nicole, for filling in that role. It's a big one, especially coming out of a pandemic, hopefully this year. And we do have a lot to cover, so I'm going to go ahead and jump right in and introduce Dr. Yoon. Dr. Yoon is the Chief Economist and Senior VP of Research at the National Association of Realtors. He oversees and is responsible for a wide range of research activity for the association, including the existing home sales statistics, which we'll probably talk about today, affordability index, the home buyers and sellers profile report, and of course, communicating to our members what is happening in the market like he's doing here today. So thank you so much for being here, Dr. Yoon. The floor is yours.
Good morning, everyone. Thank you, Ruth, for inviting. I spoke with President Nicole about the weather condition there, and apparently it is just barely above 0 degrees Fahrenheit. Wow, that is cold. I am near Washington, D.C., in fact, Arlington, Virginia, which is just directly across the river from D.C. D.C. is the office where I will be working, but right now I cannot go there. First, because of the COVID and mayor's recommendation, just stay away from DC to the degree possible. And second, the office building is boarded up. We are only 2 blocks from the US Capitol, and with the National Guard presence, the boarded up building, it's just not the condition to go back into the office. So I'm working from home, as many office worker, fortunately, in a sense that the office worker have been fairly immune from the recession condition of this past ongoing recession. The jobs are slowly coming back, but we are far from a normal condition. I mean, we have to feel for those frontline workers. I mean, the heroic efforts by the healthcare workers, but the restaurant workers, large job losses, people working in the tourism, large job losses, people working at the hotel, massive job losses. So it's been a strange economic condition where, say, office-related employment have been fairly immune because they could work from home, while people who have to interact with people quite a difficult challenges. Now, realtors, of course, you have to interact with people, but real estate, residential real estate, have been one bright sector of the economy, especially in the second half of the year. What a turnaround for the housing market. And I want to go over as to what occurred, as well as what we can anticipate in 2021. So as an economist, I speak better with the PowerPoint slide. So let me put that onto the screen. Bear with me. There we go. So let me first start with the job market condition, because this is the basis for nearly all activity. And this is the US job market over the past 20 years. And what you see on the chart is that back in 2005, 2006, that little first hump that you see, that was artificial job creation. We know that in hindsight because there was large degree of subprime lending, essentially giving mortgages with anyone who wanted it, overstretching their budget, adjustable rate resetting at higher rates, no income documentation. And it imploded, blew up. We had a foreclosure crisis. And certainly you felt that roughly 10 years ago in terms of the foreclosure crisis. But from the low point in 2010, America experienced the longest economic expansion ever, 10 straight years of consistent job creation. President Obama, President Trump, continuous 10 years of economic expansion, such that January of 2020, so right before the pandemic, Wall Street firm Goldman Sachs came out with a research report. US economy never been stronger. It is so strong, the momentum solid in a presidential election year, nothing can derail the US economy. And of course, the unexpected pandemic occurred, and in a single month of April, we lost 10 years of progress. 20 million jobs in April, which is equivalent to 10 years of job gains. So a single month wiped away 10 years. But as the economy steadily reopened, you see the job gains beginning to slowly recover. Let me put the chart in a little different way. This is the recent month-to-month changes. April is when we lost those jobs, 20 million jobs. Then you see some job creation, essentially due to the first stimulus. If you remember, roughly $1,200 per person check that went out along with the enhanced unemployment benefit. And I want to thank all the leadership of the association. I mean, President Nicole certainly, relayed the information about, what is the realtors to do during a lockdown. So one thing that we lobbied hard was to say, look, realtors were doing fine before the pandemic, and suddenly you locked us out. People cannot visit homes. What is the realtors to do? So the unemployment insurance was available for the very first time for independent contractors. So hopefully some of you were able to tap into those funds during those few months when things were completely locked down. But many realtors have indicated they don't want an unemployment check. They want to do the business. So when the economy reopened, home sales fortunately were bouncing back. But what you see also on the chart also is that towards the end of the year, November, December, and the latest data from January, things fizzling out, which was the reason why we needed that December stimulus. Late December, President Trump signed into law, which essentially is the reason why you have that additional $600 in your bank account, along with other stimulus measures like small business loans, which does not have to be repaid if you meet certain criteria. The unemployment insurance also not as generous, but another amount. President Biden is saying, well, that December stimulus is insufficient. We need to put additional amount. So it's possible that some of you may receive another $1,400 to make it into total, $600 plus $1,400, make it into $2,000 total additional stimulus check. Because economy is fizzling out and we need to kickstart the economy again. As an economist, we know there is no such thing as free lunch. So larger budget deficit, larger national debt, additional printing of the money means that the bond market, 10-year treasury yields, they're beginning to act up. They're saying we feel uncomfortable about financing US debt. Interest rate on those bonds are beginning to rise, which means mortgage rates will inevitably rise. I would say only a decimal point or two, nothing alarming, but what this means is that for your clients, you need to explain that absolute low point on mortgage rate is probably already occurred. December, January, 2.7% average mortgage rate, that is probably the low point. Longer one waits to buy a home, mortgage rate will likely tick higher, maybe about 3% towards the summer. But the stimulus measure is essentially to say we need to kickstart the economy as things were fizzling out. But by the summer of this year, medical expert believes roughly half of America will be vaccinated. By autumn, another quarter. But at that point, it's a herd immunity. So you can go see the ball games in person, go indoor dining, go on travel. So all the activities should begin to steadily return to normal sometime in autumn or early winter of this year, according to medical experts. If we look at the Madison job market, by contrast to the US, what you see is better performance. How do I know? Well, let me go back to the US job market conditions. So here it is. So the red line is a reference line to show year 2000, foreclosure crisis in 2010, and then the lockdown effect. If we look at Madison area, what you see is it is consistently above the red line, showing that job growth performance was better than rest of the country. In fact, I'm a little surprised that in 2010, the job market really did not decline all that meaningfully in Madison. Maybe your foreclosure crisis were more manageable, not a wild, huge increase in foreclosures. I know it did occur, but it was more contained in Madison area. Then you saw the 10 straight years of job creation, then the lockdown, job losses, and now trying to bounce back up. Let me also compare Madison with the bigger Wisconsin city, Milwaukee, which is a different story. As you can see in Milwaukee, greater Milwaukee, and the surrounding counties, year 2000, that the foreclosure crisis really hurt. So it went down. And then even with the 10 years of job creation, only catching up with the year 2000, and the lockdown brought it down, trying to come back. So clearly, Madison easily outperformed Milwaukee in terms of the job market condition. If we look at the 50 states, comparing December job numbers with December of 1 year before. So essentially looking at the latest data versus pre-pandemic. And Wisconsin is down 7%, which is a little higher than national average. But you can see Michigan is down much deeper, along with New York State. Only Idaho and Utah have job creation, more jobs now compared to 1 year ago. If you look at the southern states, job declines are more modest. How do we explain for some of the difference? One may be weather condition. In the southern states, at least they can do outdoor dining. So at least that helps the economy. But in the northern states, it's also the case that you had the governors imposing stricter lockdown for longer period. So if you have a stricter lockdown for a longer period, it's going to hold back job growth. But the reason for the stricter lockdown is to contain the virus. So that's the trade-off that many governors are running into. Back in Idaho and Utah, the governor essentially said, look, coronavirus is very dangerous, but we are not going to shut the economy down. Please be careful out there, put on the mask, social distancing. We cannot shut down the economy. So sort of different philosophy as to how each of the governors are deciding on their economic activity and trying to contain the virus. This recession is also interesting in the following sense. Economists look at something called GDP, that's gross domestic product. And in fact, many politicians will mention GDP, GDP, GDP. So essentially measuring the total production in America. In 2020, it's a recession. So it went down. You see 8.5% deep during the lockdown in the second quarter, and again in the fourth quarter. But if you look at the right-hand column, personal income, this is the first recession in American history where during a recession, Americans actually have more income. All of the recession, people suffered, lower income. This is the first recession ever. On average, people have higher income now compared to before the pandemic. I understand there are some families who are struggling paycheck to paycheck. If they have a paycheck, worried about their next grocery bill, worried about next housing payment. We know those circumstances, but still, on average, Americans have more income now than before. What are people doing with this income? They're not spending it. Savings rates are elevated. The deposits at the banks are at record high levels, but it also means that once the vaccine is widely distributed, again, able to go see Wisconsin Badgers play in person and other dining activity back to normal, means all this savings will be unleashed back into the economy. Economy will begin to run in a very strong way, but that's in the second half of the year or late second half of the year. Until that time, we needed the stimulus money to help us get to that point. Now, again, the debate on the size of the budget deficit, the trade-off interest rate environment, but we needed that second stimulus, third stimulus to get us into the second half when all these savings will be unleashed back into the economy. Let me now turn to the very good news of the home sales. Dramatic U-turn. So home sales collapsed. And during the collapse, realtors, I heard stories after story, uncertainty, anxiety, virtual tour, will that work or not? But once it reopened and realtors follow the right protocol on sanitizing, mask, social distancing, giving the confidence to the consumers, you can visit homes, not worry about catching COVID, giving the confidence, buyers took advantage of the situation, and home sales not only returned back to the pre-pandemic, but it exceeded, it went way beyond before the pandemic condition. So very strong home sales condition. And I know in the your region, home sales, I believe in 2020 was up 8%, which is slightly better than national sales gain. So quite a remarkable condition. If we look at the price category where the home sales are moving, so the dark orange is where the home sales changed from 1 year before. This is at the national data. The Madison region, the price points are a little bit under the national point, but it still illustrates the storyline, the narrative. Higher price points, sales growth is stronger. So on $1 million and over, which is a small segment of the market, home sales have doubled essentially from 1 year before. But if you go into the lower price bucket, home sales are barely rising from 1 year before. Or in the case of very lower price bracket, is actually down from 1 year before. So is there no demand for affordable homes while there's a strong demand for $1 million home? After all, the stock market is at record high, and therefore, people are saying the wealthy are doing well, and therefore they can buy $1 million home. But if you look at the inventory, which is the light yellow color, inventory is down on the lower price point. And as realtors will attest, there's plenty of buyers for lower price home, affordable price. It's simply not enough inventory. It is the lack of inventory that is hindering the sales growth on the lower points. That is why it's critical. We need more inventory to get the sales done. You can do more business. More consumers will be happier becoming homeowners. So we need more inventory on the lower price bucket to truly get the market going even stronger. Let me also turn towards the mortgage rates, because the surge in home sales is due to the fact that mortgage rate have hit all-time low of 2.7%. But I also want to focus attention to 2018, when mortgage rates increased from 4% to 5% from the beginning of the year towards the year end in 2018. It was part of that 10 years of job creation, great economy. Yet if you look at the data, 2018 home sales actually declined. And why did the home sales decline, even in a good economy? Because rising interest rates, to show how sensitive the housing sector is to rises in mortgage rates. Home sales surging now because of the record low mortgage rates, but reiterating, mortgage rate low point, I think, is over. We are probably going to see about 3% mortgage by late spring, early summer, and maybe a little higher, because all the stimulus money, of course, is good for the economy, but it's coming at a cost of slightly higher mortgage rate. Nothing alarming. 3% mortgage rate in summer, you say, I will take that. I mean, those are still historically very, very attractive mortgage rates. With the buyers surging, home prices are also moving up. The orange line reflects the home price growth on the median price. So nationwide, prices are up 13% in December compared to 1 year before. I think in your region, prices are up about 8%, but it's been skewed a little upward because of the expensive home sales, those larger size, more higher price points. So the median prices are being pushed upwards, partly for that reason. The blue line is something called Case-Shiller Price Index. Maybe some of you have heard of it in the news coverage. So what it tried to do is try to control for constant quality to assess true home price appreciation. And it's showing about 9.5% true home price appreciation. But irrespective of how you are viewing it, this simply means that a homeowner in Madison area, just by being a homeowner, in the past year, they accumulated $20,000 in housing wealth. So very good news. Another point of this strong price increase is that for those who are in mortgage forbearance, some of your past clients who are unable to find job, they're in the mortgage forbearance. Once that time period ends, I don't think it's going to be a foreclosure sale. So first, let's hope that stimulus leads to job creation or the vaccine leads to job creation so that people in mortgage forbearance can come out of it soundly with jobs. But those who cannot come out of it and the mortgage forbearance period, that part ends, it doesn't have to be foreclosure sale or short sales. It can simply be a normal sale because of the strong price increase. And definitely not the condition of 10 years ago, because we are in housing shortage, not oversupply, and we don't have those bad mortgages. And furthermore, again, let's just hope that people in mortgage forbearance, they can find job in the upcoming months from the stimulus or from vaccination condition. Price increases are very strong because we simply don't have enough inventory. Normal balanced market condition would be about 6 months supply, where people do not have to make those hurried decisions. But right now we are at a record low in inventory, and that's why prices are rising too fast. And at some point it's going to choke off first-time buyers. So that's why we need to assure that the home price rises roughly in line with people's income growth and not outpace it. Otherwise, it's going to be good for a few years, but in the future years, the first-time buyers will be chalked off. So we need to assure a sort of steady flow of first-time buyers with moderate price growth. So what is the prospect of getting more inventory? And good news is that builders are finally breaking higher. Builders need to build more homes. That's how we get supply. Empty homes, generally not for the first-time buyers, but for trade-up buyers. So the trade-up buyers buys the newly constructed home, but in the process, they release their old home into the MLS so the realtors can conduct their business. So we get inventory increase through building more homes, but it's going to take several years because we had 13 straight years of underproduction, meaning below historical average. Finally breaking above that, but maybe it's going to take 2 or 3 years to get us to the balanced market. But the shortage, the absolute acute housing shortage may soon be coming to an end as builders ramp up production. And builders right now are focused on single family, and rightly so. So it is single family demand, housing where the demand remains the strongest. Condominium demand, there is some, but all the data is clearly indicating that demand is far stronger for single family homes. That's why the fact that builders are focusing on single family is the right thing, right focus in the current environment. And the one thing that builders did face challenges was the tripling in the lumber prices in 1 month. I mean, it was doubling, and in 1 month it was tripling before beginning to moderate. Lumber prices really went up when there was a wildfire out in the western states. So lumber prices being high, but if we can somehow bring the lumber prices down, that means more job creation in Wisconsin. President Trump placed tariffs on Canadian lumber. President Biden has mentioned about Buy American campaign. These are all good programs to assure that the jobs in America recover. We should put emphasis on helping out fellow American citizens. But in sometimes importing foreign products can help more job creation in America. If we can bring more Canadian lumber, price of lumber will decline. That means more job creation in the Madison region, and also more inventory and more transaction possibility for realtors. So we'll see if the lumber prices begin to continue to go down. That will greatly help builders bring more supply. Let me now change subject to commercial real estate very briefly, and possibly the new economy of working from home. The office demand collapsing. Even some companies who are hiring more people, but they are not leasing out more office spaces because work from home phenomenon. Workers have demonstrated they can work from home productively. If somehow the pandemic had occurred 10 years ago, it would have crushed the US economy. We didn't have the high-speed internet to do like Zoom presentation and other work related at home. But if there's a silver lining, America had the high-speed internet, and one of the advocacy point that we are pushing very hard, and Nicole and others, local association president, all relay information to us is to say high-speed internet availability out in rural communities of America. So we are pushing hard in Congress because office demand is clearly weakening. And if we look at the commercial real estate, only data center, self-storage, industrial spaces, people are making money, but people are losing money in office, retail, and lodging. So, and we took a survey of realtor members about where is their residential choice for their clients. And realtors are saying, my client is looking to buy a home in the suburbs or rural area or smaller towns and away from city centers. City centers should be about 25%. Say people in downtown Chicago, maybe Milwaukee. I know that you have a beautiful downtown, cozy downtown in Madison, but general trend is away from the city centers and wanting to go out because work from home means you can have longer commute if you're not commuting every single day. So even after the vaccine discovery, I think many CEO will debate what do they do? Do they bring workers back to office 5 days a week? Or do they say come to office 2 or 3 days a week and other times work from home? You have demonstrated productivity. And if that is the case, people in Chicago downtown, they may say, well, why don't I just go over to Wisconsin? So the demand may begin to pick up if people do not have to commute every single day. Resort area should be less than 10%, but now popping at 13%. Let me show you this chart. This is the home sales growth between vacation counties and other normal counties. Normal counties meaning like Madison, Milwaukee, vacation counties where there's an abundance of second homes. We are seeing faster growth in home sales in vacation home market compared to other normal counties. How would you know whether I am at home or at vacation home? Why should the boss care? So given that you can work from home, which can also mean working from vacation home, or if you have those long weekends, Mondays and Fridays work from home, well, people may say, if I buy a cabin out in Wisconsin, I can utilize more frequently. So this may begin to fuel either their primary residence into more lake areas, or it's possible that people want to have a second home knowing they can utilize more frequently. So interesting trend and dynamics developing. So let me wrap it up with a forecast. First on the economy and then the housing. Related to the economy, middle column 2020, recession, economy down, job losses, but interest rates are very low and no inflation even with printing of the money. 2021 forecast is that stimulus package along with vaccine almost guarantee that it's going to be positive. I hope that new strain of the virus do not get carried away. We contain it, but it's almost guaranteed that we are going to be positive in 2021. Interest rate beginning to rise. Again, 10-year treasury acting up because of the higher budget deficit. But the inflation edging up only modestly, nothing alarming yet. As for the housing market, 2020, remarkable, the middle column, low mortgage rates, builders, home sales rising 19%, existing home sales nationwide increasing 6%, in your area, it rose 8%. Home prices up 7%. I think your home prices in Madison region up 8%, doing slightly better than national average. 2021 forecast is mortgage rate, absolute low point is already over, but nonetheless, because of job creation, new home sales up another 20%, existing home sales, well, the data point is that spring of this year will show dramatic growth from spring of last year. Well, spring of last year, it was lockdown, so it's gonna show dramatic. Maybe by the fourth quarter, there could be a year-over-year decline, but when I did the numbers, it's gonna show about 15% increase in home sales this year. And home prices in no danger of declining, very positive. So with this economic and housing market backdrop, I hope you can participate in the growth. I know that membership numbers are rising. There's nothing we can do about it. And I wish the best for new members, but it's very competitive. I understand that some realtors, I mean, it's very challenging condition. It's not certainly not an easy money business as some people think it is. I mean, it's a very, very difficult situation, but thank you for giving me this time. And now I'm going to turn it over to President Nicole.
Thank you so much, Dr. Yoon. I could sit here and listen to you all day. You always have such interesting information, and I'm sure we all learned a lot here. I'll go through some of the questions. I think you did a really good job explaining the tight inventory, and someone asked if there's end in sight, and I think you answered that, and we hope to see that certainly in 2021. What is your forecast for the value increase in the Madison area? More than 3%?
So the Madison area should be better than 3%. First, the job numbers. Again, Wisconsin state as a whole is trailing behind national average. For some reason, and maybe you know much better than I do, Madison is outperforming Wisconsin, outperforming nation in terms of the job situation. Maybe it's the knowledge base, highly educated people in the Madison region, companies want to come. So if the economy will outperform, that means the home price will easily outperform the nation. And so I get one, if there's one criticism on my forecast, which I get from other large brokers and elsewhere, is that my home price forecast of 3%, they think that it is too light based on what they're seeing in the market condition.
All right, thank you. And I know we're short on time, but if you have time for just another quick question here. Another realtor is asking about the president proposing a $15,000 tax credit for first-time home buyers. Do you think that will pass? And if so, what the ramifications could be?
So the stimulus measure under President Biden that is moving along, it does not include the home buyer tax credit. They're trying to do, it's an archaic rule, something called reconciliation, which means not requiring 60 votes. Given the Senate is now controlled by Democrat, they want to pass the second stimulus quickly with only 50 votes condition. But the homebuyer tax credit will require 60 votes. You cannot, so he has to overcome that filibuster. So you will be in later package, maybe later in the year. We will certainly be involved in that discussion. Anything that focuses on housing, enlarging the middle class is all good. But we are also emphasizing to the Biden administration to say 1031 exchange, commercial real estate avenue where people sell their land to home builders, and then they use 1031 exchange to minimize tax burden. So a lot of land sales to home builders occur using 1031. Biden can, at least during the campaigning stage for the presidency, they were saying maybe they want to take that away. So we are trying to educate to say, no, 1031 is critical to increase supply, more inventory.
All right. Thank you so much, Dr. Yoon. We really appreciate all of your time and all of your information, and you're very busy. So thank you for taking time out of your schedule to be with us today.
But thank you, everyone, and thank you, President Nicole, for inviting me.